Greetings, it is time for our monthly monetary creation report. This report has been delayed somewhat because the Chinese central bank, the People's Bank of China, has not been updating its monetary balance sheet data after December. So the data is still not up to date on that particular central bank, which is going to make our reporting a little bit inaccurate over here, but we have to do the best we can because I don't want to delay this too long. So as always, we scroll down. The four biggest central banks in the world are the U.S. Federal Reserve, the European Central Bank, Bank of Japan, and People's Bank of China. And the first three are updated through February, but the People's Bank of China is only updated through December. So not even January, but just December. Now, as you can see, the U.S. Federal Reserve is only one of the four major central banks, and it does a little over 1/4 of the total money printing, $8.3 trillion to date. And yes, it has been tightening. So you hear a lot of people in the United States screaming about how the U.S. Federal Reserve is printing so much money and that will cause something like gold to rise, gold being a commodity that's priced worldwide. No, that is absurd. The United States is only 1/4 of the total of these four major central banks, which is not even the grand total of the world. It's only 85 to 90% of the world's money printing. There are a bunch of smaller central banks, notably the Bank of England, that also do print money. But this is the data we have so far about these four. Now, as we know, only the worldwide grand total matters. If one central bank is deprinting, tightening, reducing their balance sheet, and others are printing, such as Japan, which is printing a lot, and China, although again, China is only up to date through December, these two things cancel each other out, and only the grand total is useful for us in terms of matching it up with technological deflation, which is also a borderless worldwide phenomenon. So as we scroll down here, this chart is going to be of limited use this month because it's only updated through December, but the charts below provide additional insight. This is the growth rate of the four central banks, and this too, of course, is only updated through December. But helpfully, this Yardeni report includes a chart of only the other three major central banks that are more frequently updated, the Federal Reserve, ECB, and Bank of Japan. And therefore, this growth rate is updated through February, and we still see a minus 11.1 tightening. Now remember, I say that this always has to be in the 16 to 24% growth rate band. When the rate of money printing peaked in February of 2021, the growth rate was unusually high, 46.3% if you count all four central banks, like over here. But now in the face of tightening, it is at minus 11.1%. And even if the People's Bank of China is printing, this may go up to minus 9%. It's still negative. There's no way that the People's Bank of China has printed so much as to change the entire world's trajectory. So what should be in the plus 16 to 24% range is still in the minus range, and this is very bearish for the stock market and for the housing market, particularly in the United States, because the United States money printing is in the form of mortgage-backed securities and treasuries. So half of the money printing is to prop up specifically the housing market. That is a very distortive and wrong way to do money printing, as I speak about often on this channel, but that is what it is right now. Still better than not printing. And lastly, we go to this chart over here, which shows how much money has been printed by these respective central banks as a proportion of their annual GDP. Now, this is a cumulative money printing number. Their total central bank balance sheet is not an annualized number, where the GDP is an annualized number, but we do get an idea about how much each central bank has printed relative to the size of its own economy. That's why the hysteria in the United States is so incredibly absurd, because it's the joint lowest of the four. The red line, the U.S. Federal Reserve, is the joint lowest of the four, along with the People's Bank of China. Whenever that is updated, it still won't be very different on this chart. Only 32.9% of U.S. annual GDP is what the United States has ever printed over so many years, 15 years, 32.9%. Europe, the ECB has done twice that amount, 65.5%. You would think Germans are the people most afraid of inflation and money printing, but they have still done twice as much relative to the size of their GDP as the United States. You don't see them complaining about hyperinflation nearly as much. But twice again as much as the ECB is the Bank of Japan. The Bank of Japan has done 124.7% of its GDP in money printing, and this line will rise again. It has not been fully updated yet because January, February money printing is part of Q1 GDP, and this is current through Q4 in the case of Japan. So Japan has done 4 times as much money printing as the United States in relation to the size of the GDP. Yet people in Japan aren't complaining about hyperinflation and trying to exaggerate inflation. The United States has done a very low amount of money printing, the joint lowest of the 4, and 1/4 as much as as Japan in relation to the size of its GDP. That's why U.S. tightening doesn't really matter when Japan is printing money again, as we saw. Now, because the People's Bank of China is not fully updated yet, we're not going to do our monthly scorecard that I usually show. Instead, I'm going to show you proof of how money printing is borderless. Because as we saw, going back to the top, the United States is tightening, so is Europe, but Japan is printing money again. So what does that do to U.S. money supply? This is the M2 total balance at the Federal Reserve website. M2 is a measure of how much liquid and semi-liquid money there is in the U.S. Checking accounts, savings accounts, CDs, things like that. M1 is even more short-term liquid, but that is too volatile, so M2 has succeeded it as the more accurate metric. And this is a 10-year horizon, but let's take a shorter window, 1-year horizon. Since the U.S. is tightening, M2 has been going down. Now the U.S. is still tightening, but Japan is money printing. Therefore, the net world total is rising again. And therefore, the M2 amount in the United States has risen for the first time in a long time because Japan's money printing is already seeping into the U.S. This does not mean you have to worry about inflation because inflation has been going down, as we're about to see in a minute, even though money printing has resumed. So money printing is ramping up even as inflation is going down. But this is proof that money printing is borderless, and paying attention to the Federal Reserve's money printing or any one country's money printing makes no sense because you have to match up the world's grand total to the expected amount of technological deflation worldwide. People have to think at this level in order to make accurate predictions, and somehow it's still difficult for all of the supposed experts to even contemplate that. They're still talking about the Federal Reserve and how the Federal Reserve printing money will make gold go up, even though gold is the same price as 12 years ago, despite $28 trillion plus of money printing. Now, on the topic of inflation, let's see how inflation data is shaking out in the most recent reading. So for that, we go to part 2. So for this month's inflation update, we return to my familiar matrix, which longtime viewers know about. But if you're new here, I believe that inflation has to be measured in a multidimensional sense because too much of the narrative of inflation is designed to cherry pick data points and to create a false impression of things being much worse than they are, as well as to misguide people into thinking all inflation is bad and therefore deflation would be good. Now that is extremely incorrect, and it's catastrophic that people are being brainwashed into that. But I say that there are 3 major metrics of inflation, which are the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, which I think is the most important index of the 3, and the 10-year US Treasury yield. So very symmetrical. 3%, 3%, 3%. Unless all 3 of these measures are above 3%, inflation is not higher than optimal. If all 3 were exactly 3%, I would say that is when inflation is optimal, because inflation being much lower than 3% is also a negative for a variety of reasons. 3% is optimal for wealth creation and technological disruption, as I speak about elsewhere on this channel. The reason the Goldman Sachs Commodity Index is the most important measurement of these 3 is because it is worldwide. The other 2 are US-centric metrics. The US is the largest economy in the world, so these are important measurements, but nowhere near as important as the Goldman Sachs Commodity Index because it is unriggable in that it is a composite of freely traded commodities such as gold, silver, oil, natural gas, etc. So the claim that these indices of inflation are rigged to understand inflation is completely and totally refuted by the Goldman Sachs Commodity Index because it is unriggable and it is worldwide. This worldwide dimension is important because money printing is worldwide and technological deflation is worldwide. These are concepts that have no borders at all, and therefore the Goldman Sachs Commodity Index, which is also borderless, is the most analogous and comprehensive measurement. So on today, February 16th, 2023, we can go through our usual routine of looking at all 3 of these measurements. So we'll start with this one, the Goldman Sachs Commodity Index. The Goldman Sachs Commodity Index 10-year compound annual growth rate is minus 1.34%. That is deflation. As you know, oil is still around $80 a barrel, whereas it was $100 a barrel 10 years ago, and other commodities have also not risen in price. Gold is also the same price as 12 years ago, in fact. All these other commodities have failed to rise in price because technology increases the supply of these commodities faster than their consumption can rise. And this is what people just fail to understand when they claim that gold is going to go up because of money printing. A lot of gold bugs have gone insane, and the word insane is not an exaggeration. They have literally gone insane because they cannot grasp how trillions upon trillions of dollars of money printing has still not made gold go up at all. Gold is the same price as 12 years ago, and they keep saying that it's about to rise any day now, but they're wrong. There's no fundamental economic thesis under which gold can rise, and the same is true for other commodities, especially other metals like silver. So minus 1.34% deflation. I think we're at a point where almost no amount of money printing can make commodities spike in price. Remember how just a few years ago we were hearing about peak oil and other such concepts? Quite the opposite happened. We got peak demand, not peak supply, and therefore, as I said, almost no amount of money printing can make commodities rise in price over any structural basis. Now we go to the next measurement, the 10-year U.S. Treasury yield. 10-year U.S. Treasury yield is 3.84%. That's more than 3%. This is the metric that is above 3%. Now this is an estimate of future inflation, not past inflation, but the Treasury market is tied to a lot of things, including U.S. government spending, the housing market, mortgage market, and so forth. So this is the one that is above 3% at 3.84%. And lastly, we go to the U.S. CPI. At the bls.gov website, we see the US CPI, and we go here to more formatting options, and we choose all the measurements, original data value, 1 month, 2 month, 3 month, 6 month, and 12 month rates of change. And this is the CPI index. It is at 300.536, and 10 years ago it was 232.937. And we will soon go to the table that summarizes all of this nicely, but as you can see, this 1 year percentage change has moderated down after a very brief flurry higher. Hardly an event of any significance. Same with the 2 month percentage change. It's already moderated back down to its long-term low status quo. Same for the 3 month percentage change. Same for the 6 month percentage change. Even that is all the way down to its normal low status quo. And the 1 year is drifting down. It isn't down all the way yet because this is slower moving, being a 12-month percentage change, but it's already drifting down. But when you look at the 10-year growth rate for this US CPI, it is very simply 300.536 divided by 233 and take the 10th root of that. That is a 29% growth, 232 to 300.5 over 10 years, which comes to 2.6% a year. So now we go back to our matrix. So we looked at all three, the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. And what are the results? 2.6% for the US CPI, so still below 3%. It may get close to 3%, but it's still a fair bit below that. Minus 1.34% for the most important index, the Goldman Sachs Commodity Index. It is in deflation. How can people possibly be terrified about inflation when oil is much cheaper than it was even 10 years ago, and oil is so connected to everything else, and that same is true for all other commodities as well. Most or all are much cheaper than 10 years ago because this index is at minus 1.34% a year decline. And only the US 10-year Treasury yield is above 3%, 3.84%. Now, for people screaming about the CPI and how we had temporary inflation and how that's a terrible thing until 3 days from now when you'll forget about it because eggs are no longer expensive, we go to that table that I mentioned earlier that I've also shown in earlier month videos. So all the data that we saw, 1 month, 2 month, 3 month, and 6 month, these need to be multiplied by the following factors to annualize. 1 month times 12, 2 months times 6, 3 months times 4, 6 months times 2, and 1 year. The 1 year CPI growth rate is 6.3%. That is higher than 3%, higher than it should be, but that's still a temporary blip that is already moderating down because we see that all these shorter duration windows have a low annualized rate, especially 6 month, 3 month, and 2 month. And before you say 1 month was high, well, the month before that was actually negative. So this is a very volatile measurement in the shortest sense. But this shows that inflation has already moderated down, and only this 1 year window is somewhat high and already dropping fast. It used to be as high as 9%, it's already down to 6.3. And then the longer term windows, which are more important because this is the only measurement of structural inflation, indicates that the 10-year inflation growth rate is the same 2.6%. 4.6% that we saw earlier. 5 years is 3.8%, and so forth. But none of these numbers are particularly worrisome. There is noise. Whenever there's a brief flurry of higher inflation for 6 months, the same people don't show up when there is a brief flurry of unusually low inflation dipping into deflation. And as we have seen earlier, Japan is already printing money again. The world is back into net money printing because they saw that inflation was falling really fast and we were at risk of higher deflation. Japan is already printing $500 billion a month, which is enough to tip the whole world into net money printing, not deprinting anymore. Money printing is net positive at present, and still inflation is this low. So it's really quite absurd for people to worry about hyperinflation. I encourage everyone to look at this video up here in the upper right hand corner, Kartik's Laws of Inflation, where I highlight all the various illogical misconceptions that people have about inflation and all the tricks they use to push this narrative for very weird reasons, because fear sells and inflation sells. Therefore, debating via anecdotes saying egg prices are high, or claiming that the US is the only country in the world, meaning that the US Federal Reserve printing money is what will make gold go up in price, even though gold is priced worldwide and the US is only one country, or claiming that deflation would be good, when in fact deflation would be far more catastrophic for most people than moderate inflation would be. And remember, the optimal inflation rate is 3% a year. Not lower than 3 or 0 or deflation, 3% a year. So anyway, this was the inflation update for this month, January of 2023. And I hope you find this type of content informative, because the entire media is oriented around frightening you about inflation while simultaneously training people to think that their home equity gains are not inflation, or their stock market gains are not inflation, or the fact that their job prospects are good has nothing to do with inflation, whereas in deflation you would have poor job prospects. So I hope these videos are taking your understanding of the subject to a much higher level than the mainstream narrative. Thanks for watching.